Hey everyone, and welcome to today's explainer on money and the architecture of modern finance. We're jumping right in today because we really need to demystify these completely invisible systems of modern finance. We want to expose the underlying mechanics of money itself. Think about it. We interact with money literally every single day, yet the architecture keeping this whole thing afloat operates entirely behind the scenes. So, our goal right now is to pull back the curtain. We want to show you exactly how it all works so you can stop just participating in the system and start absolutely mastering it.
To kick things off, I want you to picture a scenario. We've all been there. Imagine you just survived a totally brutal month at work. You've been waking up early, dealing with annoying customers, standing for hours, just grinding out every single shift. You're finally waiting for payday, thinking, okay, well, at least I'm getting paid. You check your email, boom, it says you've been paid $2,000. Nice. But then you open your bank account and the balance says $1,456. Wait, what? What just happened to the rest of it? Okay, let's dive into exactly what happened here with part one, the price of civilization. So that missing money, that represents the quiet, invisible systems operating in the background, just swiping cash before you even have a chance to touch it. Welcome to adulthood, right? When you really break down that $2,000 paycheck, you've got your net pay, the part you actually keep, but then you've got federal and state taxes, you've got Social Security, Medicare. And look, as incredibly annoying as it feels to literally watch your money vanish, taxes are basically the price of living inside a civilization. Governments use those funds to build our roads, fund our schools, and regulate food safety, which, by the way, is the exact reason your favorite takeout spot isn't accidentally serving you mystery bacteria. It funds emergency services and healthcare. Bottom line, functioning societies simply cost money. But here's the kicker. Taxes don't just exist in one single form. They hit entirely different financial activities. Income tax hits the money you earn. Sales tax hits the money you spend. Property tax hits the things you own. And capital gains tax hits the money your investments make while you're fast asleep. And then, of course, there's tax season. Honestly, one of humanity's absolute strangest inventions. The government usually already knows roughly what you owe, yet somehow the whole process feels like a giant financial escape room. If you guess correctly, everything is fine. But if you guess wrong, well, life gets very interesting very quickly. Some people even ignore taxes completely and, somehow end up becoming true crime documentary subjects a few years later. Right, so let's follow the money that you actually do get to keep. Part 2, banks, the financial middlemen. When you hand over $1,000 to a polite bank employee and magically see numbers appear on your screen, you probably imagine your money sitting peacefully inside this giant, impenetrable vault, protected by lasers, massive steel doors, maybe a fire-breathing dragon. But the reality is actually much weirder. Banks do not simply store your money. Not at all. They're basically financial matchmakers. They sit perfectly in the middle of supply and demand, connecting people who have money with people who really need money. And this whole matchmaking process happens through a mechanism called fractional reserve banking. When you deposit your cash, the bank doesn't just lock away every dollar for you. Large portions are immediately loaned right back out. Your money might actually be helping someone buy a house or finance a startup or buy a car or honestly buy something they absolutely shouldn't be buying. The bank only keeps a fraction of deposits on hand because normally not everyone withdraws everything at the exact same time. And hey, this system works beautifully. Unless panic hits. Because history shows us that when everyone suddenly wants their money back simultaneously, like we saw in the devastating bank runs of 1929, or even back in 2018, things get very ugly very quickly. So your money isn't just sitting there. It's constantly being acted upon by massive, invisible economic forces. Which brings us to part 3, interest, inflation, and recessions. Now, the absolute most powerful economic force of all is compound interest. Simple interest is pretty straightforward, right? It's just money charging rent. But compound interest, that is a real game changer. That's where money starts building on top of money. The growth starts small, then it speeds up, and then it speeds up again. It's like a snowball rolling down a hill. If you repeatedly miss credit card payments, a cheap purchase quickly snowballs into an expensive, painful mistake. But if you're on the other side, consistent investing over decades grows into shockingly powerful wealth. Debt compounds and wealth compounds. The only difference is which side of the equation you're standing on. But while your money might be growing, there is a constant headwind fighting against it. And you've definitely noticed this one. Inflation. You go to buy snacks, and the prices just feel higher. Gas costs way more. Things quietly feel financially heavier. That's your money slowly losing its purchasing power. The actual number in your bank account stays exactly the same, but that exact same number suddenly buys you way fewer groceries. This happens when demand explodes and too many people are chasing limited products, or when supply chains break and production costs shoot up. A little inflation is totally normal, but when it runs too hot, savings lose their value and wages really struggle to keep up. So what happens when inflation gets completely out of hand? Well, governments and central banks step in to fight it, usually by jacking up interest rates. And it triggers this very specific cyclical loop. First, borrowing gets expensive. Because loans suddenly cost more, spending naturally slows down. People aren't buying as many houses or cars. As consumers and businesses tighten their belts, demand cools off, which eventually causes prices to stop rising and economies stabilize. But I gotta warn you, this stabilization can sometimes be incredibly painful. It can trigger recessions where jobs disappear and markets fall. Economies actually behave a lot like human emotions. Optimism expands everything and fear contracts everything. But the good news? Historically, they always rebuild and recover. Underneath all of these mechanics, though, is a foundational bedrock. Let's look at part 4, trust and credit. Somewhere deep inside this massive financial system exists a simple 3-digit number that is quietly judging your behavior. Yep, your credit score. Lenders aren't looking at how smart you are or how much wealth your family has. They are looking purely at probabilities. They just want to know, will this person actually repay the money they borrow? You build that trust with a consistent payment history, a long financial track record, and a good mix of accounts. Financial systems absolutely love consistency, and they reward it with cheaper loans and super easy approvals. But miss payments repeatedly or max out all your available credit, that destroys trust, and suddenly every single financial move you make becomes vastly more expensive. Because, get this, the really crucial point to remember here is that money isn't inherently valuable. A $100 bill is literally just a piece of paper with a dead president printed on it. Those digital bank balances we obsess over, they're just pixels on a screen. They only work because society collectively trusts the systems behind them. Even gold only carries value because humans collectively assign value to its rarity and utility. Everything we've discussed so far exists strictly because society collectively agrees that our participation in it actually matters. Pretty wild to think about, right? Okay, now we're going to transition from just protecting your wealth to actively building it. Part 5, investing in creating value. Here's a hard truth. Wealth rarely comes purely from raw effort alone. Humans don't pay you based on how hard you sweated. They pay based on perceived value, and that value is created through rarity, usefulness, demand, and emotional importance. Luxury brands and massive tech companies understand this perception perfectly. If you build something useful enough, desirable enough, or efficient enough, people will gladly, voluntarily exchange their hard-earned money for it. That is exactly how businesses scale, how economies grow, and how you transition from just trading your hours for dollars to actually owning productive assets, like stocks, real estate, or bonds. And that brings us to the climax of our explainer today. Part 6, time, the ultimate multiplier. Time. It's the one thing we literally cannot buy. Everyone starts life with some potential to earn money, but nobody starts with unlimited time. While most people get stuck directly trading their hours for a paycheck, applying time to your money changes the math completely. Small investments compounded consistently over a few decades create outcomes that honestly feel entirely impossible when you first start out. And hey, it's not just your money either. Good financial habits become unbelievably powerful over the decades. Your skills compound, your knowledge compounds, even your relationships compound. A really small habit, or just a slight edge in your skill set, multiplied over 30 or 40 years creates staggering, massive outcomes. Time amplifies everything it touches. People so often look at the rich and just assume, oh, wealth comes purely from luck. And sure, sometimes luck plays a part, for sure. But time matters infinitely more. Time is that secret ingredient that turns ordinary, boring investing into extraordinary, life-changing growth. It takes the quiet discipline of saving and investing and completely transforms it into ultimate, undeniable freedom. Understanding money doesn't magically guarantee wealth, but remaining ignorant about it almost guarantees confusion and struggle. Because as we've seen today, money isn't just paper or coins. It's behavior, it's psychology, it is systems, incentives, trust, and most importantly, time. So I really want to leave you with this final thought to chew on today.
Look at your own financial habits. Are you letting the incredible power of time work against you, or are you making it work for you? Take control of the system before the system takes control of you.